So pursuant to Section 84-1411 of the Nebraska statutes, notice of this meeting was given on Thursday, April 1st, 2021. Pursuant to Section 84-1411 of the Nebraska statutes, the next regular meeting of the Board of Trustees will be held Thursday, June 3rd, 2021 at 4 p.m. in the Board Conference Room, second floor at the Teacher Administrative Center, 3215 Cummings Street, here in Omaha, Nebraska. The agenda will be kept current and available for public inspection in the retirement office at the Teachers Administrative Center during regular working hours. Pursuant to Section 84-1412 of the Nebraska statutes, the public is hereby informed that a current copy of the Nebraska Open Meetings Act is posted in the Board of Education meeting room on the north wall. So with that, Cecilia, please call the roll. Here.
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 All right. Thank you, Cecilia. Moving down to agenda item 2, Cecilia sent out the April 1st regular meeting minutes. Were there any modifications, changes, comments relative to those meeting minutes? Seeing none, I'd look for a motion to approve those meeting minutes.
So moved. So moved.
So we have
Second.
We have a motion and a second. Any comment? Seeing none, Cecilia, could you call the roll, please?
Aye.
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 Aye. All right, they are approved. Moving down to agenda item 3, discussion on the financial statements from March. Cecilia?
Thank you, Mr. Chairman. Pleased to be here with you. I do want to recognize my associate, Brian Hoagie. We're going to kind of split it up, and so you guys don't have to listen to either one of us for too long, because listening to actuaries is not known to be that exciting. Sorry, Scott. Pension actuaries, how's that?
I put myself to sleep all the time.
Yeah. Anyway, so.
I can't hear what she's saying.
You can't hear me?
Yeah.
Well, let me see if I can pony up to the table here. There, that sounds
That's better.
Better? All right, good. Now I have to try to get this to work. Is there an arrow that, okay. This is why you have to bring young people with you, if you're my age. All right. Well, again, it's our pleasure to be with you today to talk about the results of the January 1, 2021 actuarial valuation. So, we're into May. Roll your brains back to January 1 because the valuation captures everything that happened in calendar year 2020. So, a little bit of background before we jump into it. Pension plans are very, very long-term obligations. Okay, we look at the stream of benefit payments when we do the 1/1/21 valuation. They go out 75 or 80 years, and then when we bring new entrants in every year, it's like perpetually that very, very long-term obligation. There is a plan in place called a funding policy that is intended to ensure that there are sufficient assets accumulated over time to pay the benefits promised to members. But because it's such a long-term obligation and we're funding it year to year to year, we can't just set the contributions and go on our merry way for 20 years and check back in, because we could have really bad things happen or very good things, but those variations. So we do this valuation every year on the same date. It's kind of the financial checkup for the retirement system. And we use that information to kind of adjust that glide path to full funding and figure out what additional contributions need to be made so we reach that 100% funded status in the time frame that the board has set. So the main purpose is to evaluate the funding progress. We'll talk about that in terms of a couple different measurements, the unfunded actuarial accrued liability as well as the funded ratio. And then the other piece of information that comes out of this report that's very important is the sufficiency of the statutory contribution rates and whether there is an additional district funding requirement. And this report determines that amount. The 1/1/21 valuation determines the additional district contribution that's made for fiscal year ending 8/31/21. As I said, the valuation captures everything that happened in calendar year 2020, so we can measure the actual experience compared to what we anticipated or expected based on the assumptions. And then we'll talk later about risk associated with funding the system. This is an actuarial standard of practice requirement that we visit with plan sponsors and boards to help ensure that they understand the funding dynamics and where the risks lie and what the implications of those risks are. And then last and certainly not least, we're always looking to see if there are trends in the assets or the liabilities, the funded ratio that we should be aware of. Now I can't remember which one Brian said. Well, that's the hard way, but we'll do it. All right. So just a reminder, how is OSERS funded? Is it money to fund the benefits is coming from different sources? Members are contributing 9.78% of their payroll, their pensionable payroll. The state of Nebraska contributes 2%. And then the statutes provide that the school district will contribute the greater of 101% of the contributions made by members, which would be about 9.88% of payroll, or the amount that's necessary to maintain the solvency of the system, which is not a specifically defined term, at least in the actuarial world. So we need a benchmark for that. And that benchmark has been the actuarial contribution rate that's developed under the funding policy that the Board of Trustees determines as far as how much money should be going in every year to fund that benefit. And we'll talk quite a bit about the actuarial contribution rate and what drives that. All right. So the valuation is what we call a snapshot measurement. It's a point in time. If we took that snapshot today, it would look different. Clearly, assets would be different, but so would liabilities. Liabilities depend on people. Who are your covered members? Who's retired? Who's actively working? And that changes every single day. But again, it's that discipline of taking that snapshot every January 1st and then comparing what's happened in the past. And then we use a projection model to say what might happen in the future that gives us insight into the funding of the plan. We did not have any changes in assumptions, methods, or the benefit structure this year. Typically, we will not have changes in assumptions and methods unless we have an experience study. We do have an experience study scheduled later this year. You might remember, I think I was with you all in February, and we talked about what's on the actuarial agenda for this year. So we will have an experience study performed during 2021, and we will reflect any changes in assumptions or methods in the January 1, 2022 valuation. So this year we did not, and there were no changes to the benefit structure. That actually takes a change in the statutes. Remember, the future benefit payments are what drive the liabilities for the system, but we don't know exactly what those benefit payments are. We don't know the amounts for certain. We don't know when they're going to start. We don't know when they're going to end. So we use assumptions to help us kind of bridge the gap between what we know on the valuation date, which is we know a lot about the members, what their current salary is, how many years of service they have, and then we use those assumptions to project forward to determine how long will they stay in covered employment, what will their salary be when they leave, how long will they live, those kind of questions. We believe those to be best estimates, but there is a reasonable range around every assumption that we use. So there could certainly be multiple sets of assumptions that would be considered reasonable that would produce a different number. Okay, so it's sort of an imperfect process because there's so much unknown about the future. That's why we do experience studies every 4 years, is to keep our eye on those assumptions and make sure we're fine-tuning those and that they are still the best estimate. So we have what we consider the most reliable measurement of liabilities to help us fund. But having said that, assumptions are long-term, but we're measuring it year to year to year in the valuation. So it should be no big surprise that there are years where the actual experience is different than what the assumptions anticipate. Even if over the long run they're correct, think about investment return. And you might be right. Probably over the last 30 years, the investment return was 8% or higher, but year to year it's wild. So we know that's going to happen. It's not unexpected. The valuation helps us quantify that, though. And then again, the two important pieces that come out of this report is the funded ratio, which is sort of assets divided by liabilities, and then, again, that sufficiency of the fixed statutory contributions and whether an additional district contribution is necessary. So let's talk about what happened in calendar year 2020 that impacted the results you're about to see. So the return on the market value of assets in 2020 was 9.4%, which is pretty good considering how things looked about a year ago. But remember, we do not use pure market value in our calculations. We use what's called an asset smoothing method that kind of averages out the ups and downs and gives the market fluctuations time to balance out there. And so the return on the smooth value, the actuarial value of assets, was 6%, which is less than the actuarial assumption. So that produced what we call an actuarial loss, which simply means that the actual experience was not as good as what the assumption anticipated. And that amount of that actuarial loss was $21 million. So it's important to note, you can have an actuarial loss even when the return is positive. Okay, a loss does not mean a negative return. On the liability side, we actually had a gain.
What would the?
I'm sorry.
What return would we have needed to get to no loss? Do you know?
Do we have that from? I'm not sure if we typically put that in the report last year. You don't happen to have that, do you, Cecilia?
If it's fine. Do you know what it will be for this year?
I think we have that in the report this year. Brian, what would it take in 2021 to hit our bogey? Should be maybe 9? I'm sure it's in there. Can you see it?
It's okay if you don't have it. We can move on.
Typically put it in there because I always kind of like to know that. We might have to get back to you on that, Scott. That's okay.
Yeah, that's fine.
It's a good question. I really thought it was in here. But anyway, yeah, so we we fell short because we hadn't recognized all the unpleasant experience from prior years. But we're moving in that direction. As I said, we did have an actuarial gain on liabilities of just under $8 million. That kind of helps offset that actuarial loss on assets. The third bullet there is really kind of a change in how we gathered the starting salary that we use in our projections. Every year we analyze the actual experience compared to what was expected. And retirement's a little bit of a tricky one because you can have an actuarial loss from retirement from a number of factors. You could have more people retiring, right? Makes sense. You could have more people retiring at a younger age than what you thought. So even though the number might not be more than you thought, if all the 55-year-olds are out the door, it's a liability loss. Or you can have it because the amount of the benefit actually, when they go into pay status, is higher than what was anticipated in the valuation. Well, in the last couple of years, we have noticed losses, retirement losses, and it kind of got to bugging us, and we started really digging into it last year and then kind of went further in this year. And Cecilia and Jim were very helpful to give us data on actual people. So we got some people where there was clearly a big loss. And as we talked to them, we realized that what we were getting for the salary element in the data was, help me if this is the wrong word, contract salary, is that right? But obviously, pensionable pay and what they pay contributions on and their benefits based on is more like total pay. I think there are certain things that are excluded. But basically, I think, and somebody correct me if I'm wrong, but I think if you coach, that's part of your pay, right? So we were sort of missing this piece of additional compensation for some of these folks who were retiring, and so they had a bigger benefit when they left than what we planned on, and that created the loss. So actuaries, whenever they find stuff like that, have to come up with a better way to figure out what we should be using, because we don't want to keep having losses. You're going to pay for it one way or another. If you have a loss, you pay for that over the next 30 years with interest. So again, working together with staff and Brian and Aaron Shohan, our analyst, we figured out a way to get the actual pensionable salary that was paid in the prior year. Okay? So we're starting with what was actually paid in calendar year 2020 and then applying the salary scale to project that forward to future years, 2021, 2022, 2023, all the way out to whenever we think they're going to retire. So that's a better measurement, but because it's a higher pay, and benefits are based on pay, right? The liability, kind of how much should be funded at this point for these people, is higher than what it was under the other methodology. So that was $49 million that shows up in the unfunded actuarial accrued liability. When Brian goes through that kind of reconciliation from 1/1/20 to 1/1/21, you'll see that number show up. Again, nobody likes liabilities just to kind of show up, but it's really a better way to do it, and it should eliminate some of these recurring losses on retirement in the future. The additional district contribution in 20... I'm sorry?
Does that affect everybody throughout the system or just people that were at retirement?
That will affect anybody in the system that's working extra. Right, Cecilia?
It only affects someone who they are working extra duties, the individual. So they're looking at it on an individual pay basis, not a... I don't get extra duties, so my base is my base.
Yeah, I get it. So, but it could be anybody in the system, not just people at retirement.
That's correct. It showed up because people at retirement were getting higher benefits. But you're right. If you have a 25-year-old teacher that's coaching 2 sports and sponsoring cheerleaders or whatever and is getting extra pay, yeah, it affects her salary.
But it's now, and so 20 years from now when that person retires, they may not be doing that. So it may not have an impact in the future.
Right. It's fluid year to year.
Yeah, that's why I was asking.
Yeah, it's fluid. Yeah.
They may be doing it now, and 20 years from now they're not doing it. Their salary has only increased based on annual salary increases, and that extra surprise wouldn't be there at the end.
Right.
And remember, the valuation, it resets every year. So if somebody's been coaching or doing extra duties, and we have that salary, and then the next year they don't, well, the salary comes down, and that would spin off a gain. So it's
Presumably-
always self-correcting,
Presumably, you'd have somebody else who wasn't coaching the prior year was coaching now.
Mo-
and so
most
it all
likely,
washes out.
right? And I don't,
Even if they teach summer school or whatever, the teachers.
yeah, I think any extra duty,
So like myself, so this year, last year I was not a coach. This year I'm a coach. So my base was whatever I made last year, except I have other extra needs that I do too. So taking on extra classes, or studying for have subs, things like that. So that's all extra duty pay. And the thing that you're going to see a lot this year, or next year, I guess when you're looking at this year's, you're going to see a lot of that coverage, especially with the secondary, because we rotate a lot. So you'll have a lot of that going on for a few years, I'm sure. But then, like I said, the extra, I coach after school. I have the classes that I have an extra class or an extra 2 classes. So that's kind of the same, except that's a whole other lump sum. So all of that would be, but again, so last year I had a whole extra 2 classes. This year I have a whole extra 2 classes. Next year we might be fully staffed, and I might just teach my base 3 classes. So I'm going to be one of those people.
Yeah.
For example. And then 20 years from now, I hope I'm not teaching 25,000 classes at a time. But yeah, so
right,
I may not be a soccer coach next year.
right.
I got my phone.
Okay, great. Yeah, and we're using the salary scale to adjust forward, but as I said, every year we capture what actually happened, and it sort of self-corrects. If we're a little above, it comes down. If we're behind it, we start higher. That's where all that experience gain or loss comes from.
And just so I'm clear, we missed it in prior years because we just didn't think about it, or
In prior years, I'm sorry,
I'm wondering why we missed it in prior years. Why this is
because we were using contract pay,
right.
which I think goes back to we used to do valuations as of 9/1, which was tied to the fiscal year, and we would get the contract salary, the increase according to the contracts in October, I think.
Correct.
So that was sort of the most up-to-date measurement. And I think we just were using contract pay, not realizing, how much additional pay might be involved for folks. And again, it does ebb and flow with staffing and, where people are at. And generally, if they're not close to retirement, it doesn't tend to, if you're younger and you have shorter service, your liability's not as big. It's those people that are close to retirement and they get there and then all of a sudden their benefit might be, 4 or 5% higher than what we've expected. It spins off a loss that's noticeable. We can't go through all, 7,500 people every year, but the people that are creating a big enough loss that you notice it is how this kind of all came to the forefront. Is it perfect? No, but we think it's better than it was. And we're always looking for ways to improve the valuation process. Okay. Thanks for the question.
I have a question, Pat.
Yes.
With the CARES dollars, actually ESSERS dollars that school districts have received, and Omaha has gotten quite a bit, and we're required to spend 20% of those monies on learning recovery. The majority of that learning recovery, which would be outside of a regular teacher's duty, should they choose to teach, would go to our teachers, paraprofessionals, etc. It's a large chunk of lot of money. How do we? And we can make some reasonable assumptions that those monies will be available not just for the current year, but for the next 4 years. How would we account for that in this? Because that's going to be an anomaly that is not figured in. That's normally not figured in. Normally, I know we were talking about increases in salary and stuff like that. This is outside of that. How would we account for that?
Let me ask you a question before I
Sure.
answer that. So at the end of the 4 years, what happens to a person's salary?
Well, this is not additional. This is extra duty. This would be extra duty pay.
Okay.
see
But
what I'm
basically it would go away.
It would go away.
Okay. Well, I think that's really good that you brought that up because I was not aware of that. So this would first show up in calendar year 21 salaries?
22.
22?
What do you think, Mr. Roberts?
Yeah, we actually will see some in the 21-22
School year.
Mm-hmm.
Okay.
The differentiation, maybe if I can throw this out, is the federal stimulus monies will go through our grants fund as opposed to the general fund. So I don't know if there's a differentiation of payroll expenses going to one fund versus another, or whether it's just payroll, but that might be something to look at.
So would this be pensionable pay for the retirement system purposes? Will they pay employee contributions on this pay?
That part, I don't know.
That's a good payroll question.
Yeah.
I'm guessing it would just show up as additional pay or hours for those that are participating. We'll have an earnings code that we can segregate these dollars, but I don't know if it's pensionable or not. That goes to the plan document itself.
There is a definition of compensation, and there is an exclusion within the definitions of compensation.
Right.
So we will get back to you on that and talk with Scott a little bit more on how these dollars will be used.
Thank
But,
you.
yeah,
I just
thanks
think
for
it's something-
raising that before.
I don't think it is, but
Okay.
it necessarily.
Thanks for raising the question
is pensionable,
beforehand.
but it might be. So I just feel
Yeah.
that I should raise it this time.
I think that's great that you brought that to our attention, and yeah, we'll work with Cecilia and figure out first if it is indeed pensionable pay, and if it is, then we might want to make some adjustment so we aren't recognizing the full amount. Good point. Yeah, so I think the additional district contribution in 2020 was a little bit higher than the pure actuarial amount, 21.4 versus 19.8. Obviously, you put more money in, it pays your debt down directly. So that's a favorable experience. Overall, the unfunded actuarial accrued liability did increase, largely from that actuarial loss on assets and the change in the salary methodology. Brian will walk through each part of that. And then, as typically happens when the unfunded liability goes up, the funded ratio goes down a little bit. I'd say it's fairly stable, 63 to 62 on a market value, or on an actuarial basis, and 58 to 59 on market value basis. So with that, I'm going to turn it over to Brian, and he'll kind of walk you through the details on the valuation, and then I'm going to wrap up with a little bit on risk at the end. Brian.
Thanks, Pat. So as Pat mentioned, we'll go through some of the details here for the valuation, and as you're doing now, please stop if you have any questions. So the first piece that we need, Pat mentioned we have assets and liabilities. To get our liabilities, we're projecting out in the future all those benefit payments, but to be able to do that, we need to know who's in the plan as of our snapshot date, that 1/1/21. So the membership that we have is really broken into 4 different tiers, and I'm not going to go through all this, but kind of touch on a little bit just because when members become OSERS members, depending on when they're hired in, they have different benefit structures. So anybody hired before 7/1/13 is the majority of the membership. That's about half the membership. This is Tier 1, and they have a 3-year final average salary, so we're averaging their final 3 years of pay to get their benefit. And they also have the cost of living adjustment of 1.5% or the lesser of CPI. Any members that became OSERS members for Tier 2 or that were hired after 7/1/13, they had those were 2 of the things that changed. So basically, instead of a 3-year average of salary, they now have a 5-year average of salary. And the cost of living adjustment is now the lesser of CPI and 1%. So that's the difference between those 2. Once you get to Tier 3, hired 7/1/16, the changes for this group was there's no medical COLA, there's no state service annuity, and the retirement eligibility changes slightly. And then the last tier, just to kind of wrap it up, is the Tier 4 hired after 7/1/18, and they're the same as Tier 3, except for with the rule of 85, they cannot retire before 60. So again, I just wanted to give you a broad overview of this because we look at the active membership on this next slide, you can see who who's all in the plan, but really these different tiers mean they have different benefit structures or different costs to the system. So on this slide, on slide 7, we have the active membership by tier and by certificate and classified groups. The first column is the current valuation, the 1/1/21, and then we compare it to the prior year, 1/1/20. And the certificated group, we saw a decrease of about 1.5%, from about 4,855 down to a little less than 4,800. And then down towards the bottom, the classified group, we also saw a decrease in that active membership by about 4%. And you'll see if you look at each of the different tiers, as expected, tiers 1, 2, and 3 were continually decreasing because no new active members are coming into those groups. All new active members go into that tier 4, so that's why those are increasing. And so our total active population decreased by about 200 members, so a little less than 7,200 active members. So these are the members that we're going to be valuing, the active members that we're valuing. We also have, look at this here real quick, just the breakdown of the active memberships by tier. So I mentioned this before, the tier 1 active membership group on this pie chart is the blue group, and that's about 50% of the total population. The next biggest group is the new tier, the tier 4, or that orange up in the top left, and that's about a quarter of your population. So those orange pieces will continue to get bigger every year as new members come in, and the other groups will continue to shrink with the tiers 1, 2, and 3. The other members within the system, besides our active members that we just talked about, are members that are currently in pay and then members that are also have left active membership but will be due a benefit in the future. So members that are currently receiving a benefit are our retirees, our disabled members, and our beneficiaries, kind of right there in this middle of the table. And overall, we saw that population increase by about 100 members from last year. We have inactive vested members that increased by about 5%, and these are members that are no longer actively working, but they have not currently started receiving payments, and so they will be due a benefit in the future, but we still have to value those because the system owes liability, or they will have future benefit payments down the road. And then the last group of members that we value to come up with all of these liabilities is inactive non-vested, and this is any active member that has left the system, was not vested at that time, but they are still due their employee contributions. So we value that liability as well, knowing that they will get that at some point. So overall, saw about a 200-member increase in the total population, so we're a little over 14,400 as of the snapshot, January 1, 21. So that's the membership, how we develop our liabilities. The other piece that Pat talked about that we need to come up with for our valuation are the assets. And so normally when we think of assets, we think of our market value, what we currently have in the trust. But for the actuarial valuation process, we don't use the market value directly in the valuation. We use what's called an actuarial value of assets or a smoothed value. And the reason we don't use the pure market value is, as Pat said, we see lots of jumps up and down each year. And the actuarial value, or the smooth value, helps mitigate some of those peaks and valleys, and it helps to stabilize the contribution for the system, which is what we're kind of looking at. We don't want to pay a huge amount one year and then zero the next, and so that smooth value kind of helps us out. The current method that OSERS uses is we call like a 75-25 method, where it's basically 75% of the expected value if we earn 7.5% plus 25% of the actual market value. And so you can use lots of different smoothing methods. Systems use different ones. This is the current method that we are using. And just kind of in a graphical form, why we're using a smoothed value of assets is shown here. So if you see the black line going across, this is our actuarial assumption for what we're going to earn on assets. The blue line is the market value return, and then the red line is the smoothed value of the return. You can see that the red line is much smoother than the blue line, where the blue's kind of bouncing around. And so this is really the reason we used a smooth value of assets, just to kind of, again, eliminate some of those peaks and valleys and have more predictable contributions. Oops. Okay, so some details on the assets, how we got from 1/1/20 to our 1/1/21 valuation. The two columns you see here on slide 12 are the market value and the actuarial value side by side. So the market value, we started out a little over $1.3 billion. We brought in a little over $100 million in contributions and paid out $137 million in benefit payments, and then had a return of $115 million. So our market value as of 1/1/21 is $1.405 billion. Now the actuarial value, the contributions are still the same that are coming into the trust. The benefit payments that we're paying are still the same. Those are going out. But the investment income is different because, again, we're smoothing in our gains and losses over the prior years. So in the past, we had some deferred losses that were not yet recognized. And so as we're smoothing in some of those losses, that brings our actuarial value return down. And this is what Pat had kind of alluded to a little earlier. If you look at the bottom, the rate of return was 9.4 on a market value, but because of these losses that we had not yet recognized in the past, that we're now recognizing a portion of this year, that lowers the rate of return on the actuarial value to that 6%. And 6% is lower than our actuarial assumption of 7.5%, and so that difference becomes an actuarial loss, or that $21 million that we were short that Pat had brought up before. So if you look at the difference as of 1/1/21 between the market value and the actuarial value, it's $62 million different, with our actuarial value being higher. So that means we have a deferred loss. So even if we earn 7.5% next year, our return on actuarial value is going to be lower than the 7.5%. And so to Scott's question before, we can come up with that number to say what the return needs to be above and beyond that 7.5 to earn 7.5 on an actuarial value. Okay. So we talked about our liabilities, we talked about our assets, we compare those two, and that's really how we get our funded ratio. Our actuarial accrued liability minus our actuarial value of assets is what our unfunded actuarial accrued liability is. So slide 13, we see the comparison of these two numbers for the current year and the prior year. The actuarial value of assets did go up by about $50 million, but our liabilities went up by more. So both are going up, but the liabilities went up by more than the assets, so that increased our unfunded actuarial accrued liability. So we're sitting at about $914 million currently. As Pat mentioned, fairly stable, but our funded ratio did come down from 63 to 62 on actuarial value, and then it went up a little bit from 58 to 59 on a market value. And as we're developing the funded ratio or our contribution rates or our unfunded actuarial liability, we are using that smooth value of assets in all these. So market value isn't used when we're coming up with all these metrics. So just a graph of the historical funded ratio on slide 14. You can see over the last 4 or 5 years, we've been fairly steady, maybe downward trend a little bit, but right around the 60 to 65% funded ratio. A couple of peaks and valleys in here. If you go back to, I think it was 2007, you see a big jump in that year. And that was a change in the actuarial value of assets to use or to reset to the market value. And so that increased our assets at that point and increased the funded ratio. And then, of course, the Great Recession hit right after that, and then it brought it right back down, and you see the big decline until, see, about 2017, we saw another decrease. And this was when we had the prior experience study, and we decreased the assumed rate of return from 8.5 to from 8% down to 7.5%. And so if we're assuming that we earn less in assets, that means we need to fund more to the system because our benefits don't change, and so that increased the liabilities and decreased the funded ratio. So those are kind of the peaks and valleys in there, and kind of the trend that we've seen the past 15 to 20 years. Okay, and so on slide 15, we look at the change in the unfunded liability from the prior year to the current year. So we started at $848 million. We had, I won't go through each of these. There's a few of the bigger pieces. The investment experience we talked about was an increase of $21 million, so that increased our unfunded liability. We did have liability experience, a gain on experience, and so that decreased our unfunded liability by about $8 million. And the main portion of that decrease was salary increases that were lower than expected or lower than our assumption. And then that valuation salary methodology or refinement increased it by about $49 million. So see, overall, we increased by about $60 million, so we're at that 914. But there's all the different pieces there with kind of the main ones that we just went through. The next piece is kind of the main piece of the valuation is our contribution. Like what do we need to put into this system to make sure that we're continuing to fund so we'll be able to pay these benefits in the future. And there's really two main pieces to the actuarial contribution rate. The first piece is the normal cost rate, and this is the ongoing cost of the system. All those active members that we talked about, tiers 1 through 4, they all have a cost to if they hit all of our assumptions as we're going out. And so we're funding for that benefit that we assume will be paid in the future. And this is the normal cost or that ongoing cost of those active members. The second piece of the contribution rate is called the Unfunded Actuarial Accrued Liability Payment, or the UAL payment. And it's really trying to come up with a systematic way to pay off that $914 million that we just saw on the last slide. So it's not uncommon to have one, but we need a systematic way to pay that off. And so the way the system pays that off, or is set up to pay that off with the funding policy, is to pay it off using a level percent of payroll. So if you think about a mortgage on a house, you're going to pay the same exact dollar amount for 30 years, or however long the payment is, until the liability is gone, until the house is paid off. This is slightly different because the payments that we're making to pay off this unfunded liability are increasing with payroll. So if instead of saying we're going to pay $1,000 a month and it's going to be the same level payment, we're going to start at $800, and every year we're going to ramp up. And the reason we do this is because we assume that payroll will continue to grow as well as active members continue to get paid more. And so that keeps the payment level as a rate when you divide that payment by the payroll. And so that's the whole level percent of payroll. The other piece of this payment is that we pay it off in layers. So every year we do evaluation and we have experience, actuarial gains, actuarial losses, and that new difference will be paid off over a 30-year period. So this year we're going to have a new base that gets paid off over 30 years. Next year, unless there's a miracle that happens and we hit every assumption exactly as we thought, we're going to have a gain or a loss, and we're going to pay that over 30 years. And every year, each of those payments decrease by 1. So they're closed periods. We'll start at 30, 29 next year, 28, and then we'll have a number of different bases. So that's how we set up the UAL payment. Those two combined equal the actuarial contribution rate, which we see on slide 17. So again, we're comparing the current year to the prior year. Looking at the first line, the normal cost, again, this ongoing cost of the system, was a slight decrease from the prior year, so down from 12.88% to 12.76%. The amortization of the unfunded liability in the next row increased a little bit from the prior year, and so our total contribution rate is 27.53%, up about 20.28% from the prior year. The statutory contribution rates for members and the state are all the same, the 9.78 for the members, the 101% for the employer, and then the 2% for the state. And so kind of down at the bottom shows the additional required district contribution, which is 5.87% of pay. The projected pay for the year, for the upcoming plan years, $374 million, which equates to an additional required district contribution of $22.2 million. So up a bit from last year, mostly because of the pay increase. The rate increased a bit as well, but 22.2. And then just to kind of reconcile the contribution rate, similar fashion to what we did with the unfunded liability, how do we get from last year to this year? So again, I won't go through all these, but can I touch on a few? So the investment experience we talked about, that was a $21 million increase in the unfunded liability. That increased the contribution rate by 0.34%. The liability that we talked about, that $8 million that came down on the unfunded liability, was about 0.13% that decreased. The payroll growth, different than expected. So this was, we mentioned, salaries did not increase as expected. They were a little bit lower, as well as our active membership declined. So overall, that decreased our total payroll. And since we're coming up with rates, everything is divided by payroll. If our payroll shrinks or even doesn't grow as expected, that increases our rate. And so for our payroll not growing quite as much as expected, that increased the contribution rate by 0.37%. The last one that I'll point out is that valuation salary methodology. So while we did have an increase of the $49 million in the unfunded liability, because now we're projecting higher payroll in the future and everything gets divided by payroll to come up with these rates, that new methodology actually decreased the actuarial contribution rate by 0.07%. So our liabilities did increase, but now our payroll's higher, and so it decreased the rate overall. So those are the pieces to help us get to that 27.53% total contribution rate. And then just lastly, we do run a valuation model each year, which is essentially, as Pat said, we do a snapshot valuation January 1, 2021. We'll do a model where we build in all these assumptions, assuming everything is met, essentially do an evaluation as of 1/1/22, 1/1/23, all the way out 30 to 50 years. And that's not to project or predict what we think will happen, but to kind of give us an estimate of where we may be going. So that's what we did here on slide 19 to help us estimate the projected additional district contribution if all assumptions are met. So this is saying we're going to hit exactly 7.5% return. Everybody's going to retire when we think they're going to. Everybody's going to die when we expect they're going to, which we know won't happen, but it kind of gives us a general flavor of where things are going. So the 2022 additional district contribution is expected to be about $23.5 million, and then continually increase by about roughly $1 million each year. And the reason, again, we're going up, we have those deferred losses that we need to recognize. So even if we're earning 7.5%, on an actuarial basis, we're not quite getting there because we're phasing in these deferred losses. So that increases the contribution rate. And then as well, the payroll, we assume, will continue to grow. And if payroll grows, even if the rate stays the same, the dollar amount will continue to grow. So those are really the two drivers of this trend of the contribution amount continually go up. So I'm going to pause there before I give it back to Pat to talk about some risks and wrap us up and see if there's any questions.
I don't have a question. I just have a comment.
Sure.
On slide 17, you show the normal cost as being 12.76% of pay, which is the cost of the underlying benefits, correct?
Sorry?
Is that the cost of the underlying benefits this thing on?
Yeah, that is the cost of the ongoing benefits. For
and
the
underlying benefits are only 12.5%, 12.75% of pay. Well, I guess my point is benefits are not too rich. 12.5% of pay for the benefits is entirely reasonable. I often hear people say that their benefits are too rich, we need to cut them back. They are not too rich. 12.5% is a reasonable figure.
Yeah, and I guess I won't comment on whether it's a rich benefit or not. We kind of see them across the board depending on what type of system we have. But yeah, that is what that represents, is basically the amount of the benefits for those active members. Sure.
I might just add to that, Roger, that that is not uncommon as we look across the public plan landscape, that the sort of ongoing cost of the benefits for active members is usually less than half the total cost. And it's because of kind of what we've come through in the last 20 years between investment returns, longer life expectancy. There was one other thing I was going to mention. I can't remember what it is now. And lowering the investment return assumption. So all of those things are increasing the unfunded liability, and it's taking a lot of resources to fund that. So your point is well taken, but it definitely is across the entire public plan arena. Everyone struggles with that. Any other questions on the valuation results? I have one follow-up on your question, Scott, before we move on. The real person that does the work answered the email. So if we hit a return of 12.4% in 2021, that will give us a 7.5% return on the actuarial value and no experience gain or loss on assets. So that's helpful, hopefully. Mm-hmm. All right, so we're going to kind of change directions a little bit here. The actuarial world is very interested in making sure that consulting actuaries are communicating with boards and stakeholders, and again, making them aware of the risk associated with funding these plans. And so ASOP 51 is a relatively new actuarial standard of practice, is what that ASOP refers to. And I think it was first effective in the 19 valuation. We were sharing some of this information before. And again, it's all about assessing and disclosing risk. And risk to an actuary is a little different than risk is to investment people or normal people. Risk is just really uncertainty and variability. Okay, the risk is that actual experience will be different than what we're anticipating with the assumptions. And different could be better. We get a return of 9.4. That isn't necessarily bad, but it is a risk. It's variability. And so that's kind of how we look at this risk assessment. We tend to focus on, the risks that increase costs and liabilities because it's much easier to absorb favorable experience than unfavorable. That's just the real world. One thing that, there's a whole section, by the way, in the report on risk analysis and assessment. So if you like this, which would be unusual, you could dive into that, and we're happy to talk more about that at another meeting if you're interested. So we're just going to hit a couple of big picture things right now. It turns out that the maturity of the plan is very material to the funding risk. And that has to do with the relationship between the size of the assets and payroll. This plan is very mature because it's older than I am. And I think we said it goes back to 1909, which is quite a bit older than me, I'm happy to say. But what happens is when you start these plans, you implement it, your size of your population is smaller, salaries are smaller, you're putting contributions in every year, it's growing with contributions and investment income, and over time, the assets, again, they're growing more than 8% because early on you're contributing and your benefit payments are lower, but payroll might be growing maybe 4%. And so over a really long period of time, the assets become way larger than the payroll. Well, what happens when we miss on an assumption for investment return or even mortality that affects liabilities? Well, we recoup it as a percent of payroll. So as those assets get so big in comparison to payroll, it takes a big percent of pay to make up for it and pay it back over 30 years. So that's why we look at different measurements of maturity. Again, where we're at right now with OSERS and our funding, any additional piece, any variability that flows through hits that bottom line for the additional district contribution because the current fixed contributions, are not sufficient. So if it goes up another 1 or 2%, it'll come through straight through to that bottom line. So that number is fairly leveraged, which we've definitely noticed in the last few years. So a couple of charts. This one is really a graph of actuarial liability and asset values. The red line is the market value of assets. The orange line is the smooth or actuarial value. Okay. The total bars are actuarial accrued liability. So theoretically, that's how much should be in the trust fund in a perfect world where all assumptions had always been met and the actuarial contribution had always been made, and people died according to schedule and got salary increases and retired, and it never happens. But that's theoretically what our target is. When we get to 100% funded, the orange line is at the top of the blue bar. The dark part of those bars are retiree liability. Okay, and the top part is basically active members, a little bit of inactive. And you can see, liabilities pretty much always go up. Now, they spiked in 2017, as Brian pointed out, because the assumption change where we lowered the investment return assumption from 8 to 7.5 had a big increase in the liabilities. And we also went from measuring valuations at 9.1 to 1.1, so we had really more than a year there. So the spike there, but basically that trend line, if we projected that out for 25 years, it just keeps going up, at a pretty normal pace if you don't change assumptions. Those tend to be much more predictable than the asset line, which you can see with the red line, where the funded status of the plan was fairly strong in the early part of this period. And then, we can see in 2009, and we all remember what happened with the financial crisis, and the market value of the assets went down, and then they kind of worked their way back up. And then about 2014, we were into the light blue bar, and then it kind of came down when we changed that investment return assumption in 2017. At that point, the market value of assets was actually less than the retiree liability. Now, that isn't a crisis, but, you'd kind of like to know you have on hand the amount of money, the value today that you need to pay people that are already drawing a benefit. So it just speaks to the funding status funded status of the plan. Now that's come up a little bit, and in 2021, market value is about equal to the retiree liability, and the smooth value is actually a little bit higher. Obviously, as we keep working through time, if nothing else changes with the funding progress over the next 30 years, the orange line would catch up to the blue bars. That's the funding plan or funding policy. There is a measure called the asset volatility ratio that really speaks to this whole maturity of the plan. And it looks simply at the ratio of market value of assets to payroll, to covered payroll, the payroll that pension contributions are made on. So if we just look at Jan 1, 2021, Brian went over this with you. The assets were $1.4 billion. Payroll was $364 million. That ratio is about 3.9. So what that means is if we miss our benchmark, or 7.5%, by 10, so we underperform by 10, that means the return is actually a minus 2.5 instead of 7.5. That generates a loss that's equivalent to 39% of payroll. And that's how we have to recoup that, is that based on payroll-related contributions. Now that gets spread over 30 years, amortized over 30 years. We do smoothing so we don't get quite the big impact immediately, but sooner or later, when it all works through the pipeline, that equates to about 2.25% of payroll. And it's just to give you a sense that, missing the mark by 10%, given the asset allocation in any one year, is not unusual or unexpected. I mean, we've seen those kind of numbers all over the board, whether they're above, whether it's 17% or minus 2. So that's really what is the challenge with funding these plans. If we we're guaranteed to earn within 1% of the assumption every year in the future, we wouldn't be having these discussions. But it's that variability way up and way down that really creates a challenge from a budgeting standpoint. This is similar to the graph that Brian showed you. And in fact, the blue bars are the bars that were in his chart. Nice and pretty, all the assumptions are met every single year, including the 7.5. And then there's the wild card, which is the blue bars. Well, what if? What if the return in 2021 is a minus 2.5 instead of a plus 7.5? What would that mean for the additional district contribution? Because that's really the leverage part of the funding, which makes it very difficult for the school district. Again, we're smoothing and amortizing over 30 years, and those are both in the actuarial toolbox, but that's about all that's there. I mean, sooner or later, you have to start paying it back. And you can see, because, excuse me, because of the smoothing, the difference in 2022 is not as significant. But over time, you go out to about 2028, and my eyes aren't that good. You have to put in close to 40 million. Yeah, about another 10 million in that year compared to where you were if you just hit 7.5. Just 1 year. It's 1 year. Now, hopefully, if we have minus 2, we have a year somewhere else that's plus 17, 18 to help kind of offset that. But this is just, again, a reality check, an understanding of the drivers of this additional district contribution and why it can be so volatile from year to year. And that's, really quite honestly, part of the reason that we do the model is so we can see these kind of trends and communicate them and help the district get ahead of that. One other risk-related discussion, and then we'll wrap up. This is also in your evaluation reports. It's simply showing you the impact of changing the investment return assumption. Every other assumption remains the same. This is the most powerful one, and so we're saying, what if we were not using 7.5, but we were using 7.25 or 7%? What would the January 1, 2021 valuation results look like? Just how powerful is this assumption? Well, the numbers are there, and you can see 3 rows down the contribution shortfall that Brian reported you was 5.87% of payroll. If we were at 7%, we're looking at 8.85% of payroll. Okay, it's very, this assumption is quite powerful because all those future benefit payments we're saying what's the value today, and if the earnings on that money is lower, we need more money today. That's basically the bottom line. And the district contribution would be $33.4 million instead of $22.2 million. The unfunded liability would be almost $1.1 billion instead of $914 million, and the funded ratio would be about 58% instead of 62%. I think it's also interesting, we look at funded ratio, we like that number because it's a comparison of 2 really big numbers, but sometimes people think, oh, the funded ratio only changed a couple percent, it's no big deal. Well, you can see it kind of is when you're looking at these kind of numbers. So that's just an informational. Again, sometimes it helps to quantify these things instead of just, talk about it in words. Ooh. All right.
So when is the review of all the assumptions? Would that then bring up the discount rate assumption, or when do we talk about that?
We are scheduled to actually start performing the experience study really as soon as we get done with this meeting. We might take a day or 2 off. We're hoping to have that to you later in the summer. We may want to break that up. It's an awful lot of information to do a deep dive on economic assumptions and demographic. What we've been doing with a lot of clients is sort of breaking that into 2 pieces, so it's not quite so much material to digest at one time. So we might do demographic first, And then I'd like to do economic when we get the 2021 assumptions from Aon through the Nebraska Investment Council. And those, I think, don't normally come out until August. Is that right, Cecilia? It's after June 30. The capital market assumptions from Aon.
August or September.
Yeah. So it may be fall before we get to it. But yes, all assumptions will be reviewed, as well as actuarial methods. And we will make recommendations. Ultimately, the board decides. You guys are the fiduciaries. You have the hard job of actually making the decision of what assumptions to adopt. But we will make recommendations. We'll show you our analysis. We'll explain why we're making the recommendations we're making. So the good news is, we get started in June. We've got plenty of time. We'll use them for the Jan 1, 2022 valuation. So if it takes, 6 months to get there, it takes 6 months to get there. I'd rather take.
So we did update the discount rate. That would impact 2022 contribution?
Yes. Yes. All right. I'm just going to wrap up. Again, just sort of summarize. We saw the funded ratio decline, slightly. Again, we had sort of a mixed bag on experience. We had a loss, actuarial loss on the smooth value of assets. We had a gain on liabilities. We had that adjustment in our salary methodology that increased the unfunded by $49 million. We do still have an investment loss, but it is smaller than it was a year ago. We took a bite out of that this year. We took a hit. Additional district contribution is up $22.2 million. It was 19.8 in 2020. The reality is, I think, given the funded status, the market actuarial values, it looks like an additional district contribution is likely, certainly in the foreseeable future. We'll see when everything shakes down on the experience study, how those changes impact, the funded status and the additional contributions. That'll be part of what we'll look at after we decide kind of what the recommended assumptions are. Then we'll look at the financial impact. We'll use the 2021 valuation just to measure that, but we won't change the 2021 valuation. We'll use the new set for Jan 1, 2022. Any other questions?
So everything's based on funded ratio. You're talking 100%. You're talking about the funded ratio.
Yes.
For the next 30 years. So scenario-wise, is it safe to say you're looking at right around the 80% in 15 years? The way your numbers are.
I don't know. Do you know, Brian? Do we have a projection in here? That is a good question.
This fund's never been 100%.
Well,
20 years.
yeah, best laid plans.
Right. I understand.
Yeah.
I'm breaking everything in 50%.
I don't know if we've got that. We can certainly get back to Cecilia and she can let you know. In fact, Cecilia, we'll include a couple of graphs and make kind of a memo that you could supply to the board, because the model is really helpful and insightful, and so I think it would be worth sharing some of that directly with y'all. Okay, thank you for that question.
Any additional questions? All right, seeing none, Brian and Pat, great explanation. I really appreciated how you patiently walked through that and went line by line. It was exceptional.
Good.
Thank you.
Thank you.
Okay, so with that, I'd look for a motion to accept the 69th annual actuarial report for OSERS as of January 1st, 2021.
So moved.
I move the Board of Trustees accept the 69th annual actuarial report for the Omaha School Employees Retirement System as of January 1st, 2021 as final, and instructs the Executive Director to file such report with the OPS Board of Education President.
All right, we have a motion
So moved.
and a second. All right. Any further discussion? All right, Cecilia, take the roll.
Havlicek,
Aye.
Logan. Hersenbach.
Aye.
Johnson.
Aye.
Ray.
Aye.
Playcheck. Bourne.
Aye.
7 ayes.
All right, thank you. It is accepted. So the final report will be issued for publication. It'll be posted to the OSERS website and then given over to the Omaha Public School Board of Education president. So, okay, next we'll go down to agenda item 5, discussion or action on legislative report. I had an opportunity to visit with Jack Peets, our lobbyist. He said most of the last few weeks since our last board meeting have been consumed with various tax bills. He mentioned, I don't know, it was yesterday or the day before, that LB 147, the bill that deals with OSERS and NPERS, had been scheduled several times and they didn't get to it. As I was walking into the building, apparently I heard that they're just starting to debate on it. So,
Yeah.
what's that? It passed? Okay. So it did get advanced, so now it goes to ENR. So I think, I don't know if by our next meeting the legislature will adjourn, but when it does adjourn, we'll have Jack in person to kind of do a end of session wrap up and see everything that went on. So that's kind of all I have on legislative matters, unless anyone else has any other additional information. All right. Seeing none, we'll jump down to agenda item 6, discussion and potential action on the compliance audit RFP. Cecilia had sent out those responses to RFP, and she'll review those. And of course, the board has, Cecilia and her team has made a recommendation. So, with that, Cecilia, would you kind of walk us through those RFPs and the responses and timelines?
Okay, so the RFP proposals, as we discussed at our last meeting, were due April 9 by 4 o'clock, and we received 3 proposals in total, all within the time frame. So in alpha order, we received proposals from Groom Law, Ice Miller, and QTAC Rock. The proposals were sent to all the board member trustees, like that following Monday. And staff also reviewed the proposals, and after a group consultation and debate, concluded the ranking of the proposals in the following order: Groom Law, Ice Miller, and then QTAC Rock. That ends the report, and so now the recommendation to the board is whether they want to engage from our recommendation and have the executive director and legal counsel engage with the firm we're recommending, which is Groom, or whether they want to do an interview with the top 2.
So I guess I'd open it up for discussion, and as Cecilia mentioned, we can, if the board's comfortable, we can approve it today. It's not unusual to have the 2 top finalists, I guess, come in for a presentation and discussion. So I just kind of open the floor up to anyone's thoughts on where we want to proceed.
I do have a couple of questions about the ranking. I'm looking at the scoring outline that is provided to us, showing a Groom Law with average of 213, Ice Miller 203, and QTAC Rock 126. Ice Miller and Groom Law seem to me to be roughly equivalent. The difference between them, I think, is largely the price. Ice Miller is lower than Groom Law, and it looks like the technical approach score for Ice Miller is higher than the technical approach for Groom Law. I'm not sure if the company overview would have that much of a weight on me. If I were to make a recommendation, I would make a recommendation for Ice Miller being the low cost, as well as the one that appears to be the best of the 3.
I guess, Cecilia, do you have any thoughts on, where you and your staff had kind of come in on the technical component of it and the other items?
It was the way they presented their technical analysis in the RFP. So again, it's as was mentioned once last week, sometimes it is, last month, sometimes it is also that one-on-one discussion that might ferret out a difference.
I would recommend that we bring them in. You get what you pay for.
By video, yeah.
Yep.
So, Dr. Logan, that'd be at the next OSERS meeting? Okay. Thoughts, further discussion?
And you're asking for the top two, is that correct? Okay, that works.
Okay, so the recommendation is that we bring in the top two, which would be Groom and Ice Miller, at the next OSERS board meeting for kind of a presentation and a discussion. Okay, and seeing general, we won't take a vote, just seeing general agreement. So I think it's prudent, given the size of the RFP, that we'll do that in June. Okay, thank you. Next agenda item, discussion, potential action on the OSERS board policies and procedures manual. You recall that was a kind of a gap that we had identified some time ago, that some of our board policies and procedures needed to be updated. Cecilia and our legal counsel, Peter, have worked on that. We approved some of those at a previous board meeting, and I think Cecilia and Peter will talk about where we are with the completion of those items.
Okay, thank you. Since the last meeting, we added two more policies to the manual: qualified domestic relations order policy and a uncashed checks and missing participant policies. We've done a little bit of cleaning up of the document. There's still a couple items that we want to clean up, just typographical type things, table of contents and so forth. But we feel, based on the comments that have been received and the review, that the policies are in a position to be adopted with the minor tweaks that are yet to be done.
Okay. Discussion on the, and again, Peter, this is kind of, as we've looked at it, this is the extent of everything's been updated and brought, all the policies and procedures with this would be up to date and everything's
Yes.
Okay.
This is the final document. We can always add policies as issues arise in the future, but this handles all the matters that are outstanding.
Okay. Questions, discussion on the last two policies, procedures? Are we ready to adopt? If so, I'd look for a motion to approve the OSERS board policies and procedures manuals effective May 6th.
So moved.
Second.
We have a motion and a second. Is there any discussion on those?
I just have a question about policy number 10. There's a number of things that are underlined in that section. Are the things that are underlined simply editorial things that you were going to add and just have the underlining has not been removed? Is that my interpretation of that?
Mr. Ray, I believe you just made the copy I pulled for your board package was probably the edited version, not the cleaned version.
Okay, that's what I thought. I just want to make sure.
All right. So once.
There's some underlying language here just for some emphasis. For example, it's the responsibility of the member and or the alternate payee to notify the plan in writing that a quadro may be issued. We just want to make sure that there's where the responsibility lies.
Okay. Further discussion on the policies? All right. Seeing none, we have a motion. We have a second. Cecilia, would you take the roll?
Ray?
Aye.
Havlovic?
Aye.
Playcheck?
Aye.
Hersenbach?
Aye.
Logan? Johnson?
Aye.
Bourne?
Aye.
7 ayes.
All right. They are approved. Cecilia, Peter, thank you. Nice work. Appreciate it.
Thank you.
We'll move down to the executive director's report. Cecilia?
Not much to report. At our June meeting, we will have an educational session by Kavanaugh McDonald on talking about the discount rate and how we actually calculate smoothing, so it becomes the board can better understand the impact of smoothing. And then later we'll talk about the other assumptions and the demographics. Also, at the last meeting, Dr. Logan asked when was the Nebraska Investment Council July retreat, and I just couldn't remember the date off the top of my head. So it is Thursday, July 8th, and it is scheduled to be held at Quarry Oaks down in Ashland, Nebraska. That ends the Executive Director report.
All right. Any questions for Cecilia? Okay. Seeing none. Agenda item 9. Are there any of the trustees that have anything to update the board on?
I do have one item. This last week I participated in an NCTR webinar on the reactions of retirement systems to COVID problems around the country. There was one rather surprising development out of that. A number of retirement systems said that the number of fraudulent unemployment claims that they saw in their retirement systems went up substantially during COVID. And when the first person mentioned it, I thought that was just an anomaly. And then about 3 other directors who were on the line said they saw the same thing. I don't know if we've seen that as well, but it's just a kind of interesting thing. I said, what type of fraudulent unemployment the numbers you're looking at? I said, well, we have a staff of 200 in our retirement system, and 4 of them had unemployment claims that were filed in their name, and they're not unemployed. I just found that kind of fraud really interesting.
All right. Any other input or comments? Okay. We'll move down to agenda item 10, discussion potential actions on payroll, retirements, deaths, refunds, and accounts payable. Cecilia had sent those out to everybody previously. Cecilia, you want to kind of give us a high-level review of the document?
Certainly. For the month of May, payroll, pension payroll is $11,209,000 to 589 payees. Staff payroll remains at $32,300. We have 6 new retirements for the month of May. Their first pension check will be June 3rd. 4 of them are vested people who have aged into retirement, and the other 2 are actual active employees who have elected to retire now. For the deaths, we have, for the month of May, we terminated 7 pension payrolls, taking off $9,500 from the payroll, and we had 3 deaths that resulted in a joint and survivor annuitant receiving payments, so that reduced their payments by $8,400, but we are rolling over $7,200 to the joint annuitants, so it somewhat balances out. For refunds, so these are former employees of OPS who have elected to take a refund of their employee contribution. For the month of May, we are processing 43 requests for a total of $499,243, with the average being $11,600 and the median being $4,800. Average years of credible service from this group that has left is 3.6 years, with the median being 2 years. For the fiscal year, we are at approximately 82% of what we distributed in total last year for refunds. Our accounts payable for the month of May are 2 vendors for a total of $18,000. That ends the report.
Okay. Any questions for Cecilia? All right. I'd look for a motion.
I move the Board of Trustees for the month of May ratify pension payments in the amount of $11,209,845.27 to 5,089 payees. Approve staff payroll in the amount of $32,303.18. Approve 6 new retirements effective May 1st, 2021. First pension check paid June 3rd, 2021. Ratify the termination of 7 retirements due to the death of the retiree and the continuation of 3 joint and survivor annuity pensions. Approve refunds of $499,243.84 to 43 former employees and members of OSERS. And approve accounts payables in the amount of $18,069.17.
All right, we have a motion. Look for a second.
Second.
We have a motion and a second. Any discussion? Seeing none. Cecilia?
Playcheck.
Aye.
Logan. Havlovic.
Aye.
Ray.
Aye.
Johnson.
Aye.
Hersenbach.
Aye.
And Bourne.
Aye.
7 ayes.
All right, it is approved or adopted. Any new business for the board? Nope. With that, we'll adjourn at 5:26. The next meeting is Thursday, June 3rd at 4 p.m. Thank you.